Okay. Welcome everybody to today's webinar. This is what we call our deep dive webinar. Today we are going to be looking into what you can do as business owners to reduce your taxes. I know that's a pretty popular item or issue. So let's go ahead, and you've, I think, had time there to read the disclosure. I've got a little PowerPoint. I'm going to be mostly reading the PowerPoint, making little comments on the PowerPoint as we go. As you have questions, you can go ahead and chat those questions in, and we'll get to those after the PowerPoint. Now, everything that I'm going to present is not comprehensive. It's not everything you could possibly ever do. So if you have questions about things that aren't in the PowerPoint, go ahead and chat them in, see if we can't get some answers for you. Or if you want clarification, that would be great as well. I'm going to go ahead and get going here. And let's just go through some of this. The first thing that I will tell people on how to reduce your taxes is actually this: to maintain good accounting records. If you don't know what your books are, if you don't know what your income is, how can you plan? How can you make adjustments, right? So first of all is maintaining good accounting records. And here's a couple of things that you really need to do. Or what they do for you, right? So accurate accounting records are vital to understanding what you are spending money on and how much is being spent. Okay. Good accounting records will help you as a business owner identify the areas you can spend less and maybe even areas you want to spend more. Okay. Now, side note here, one thing that I also tell people is, and I don't know if I'll remember this later in the webinar, so may as well get this out of the way now. Sometimes I'll have a client ask, should I spend money on XYZ because I get a deduction? The first thing that I ask them is do you need it? Do you need whatever it is you're talking about spending money on in your business? And if the answer is no, I'll tell them no. Right? Why would you spend $10,000 to save $2,000? You're still net out $8,000, right? So we don't want to spend money just to spend money in the hopes of lowering our tax liability, but there's some things that we can do where that will help us move our businesses along and lower our taxes at the same time. Okay, and that's what we want to talk about. Okay, back to good accounting records. Keep your business expenses and your personal expenses absolutely separate. Do not commingle them, is what we call it when you put them together. Don't do that. Maintain separate bank accounts and credit card accounts, right? Business accounts and personal accounts. Don't cross over. And keep your documentation. Okay. Now, I get this question quite a bit off as well. Are bank statements and credit card statements, are those sufficient? The answer is no, they're not. You do need to keep receipts. And the reason is receipts will show what was purchased, not just where and how much. Okay. And so you do need to keep receipts and other documentations if you've got invoices or things like that. Keep those as proof of the expense. Okay. Now, understanding what deductions are common for your type of business. This is important because deductions in one business may not be a deduction in another business. Okay, so you need to identify what deductions can be taken in your business. Okay, now the Internal Revenue Code, not written by the IRS, written by Congress. Okay, the Internal Revenue Code states that deductions can be taken for ordinary and necessary expenses. Okay, and like I mentioned before, what is ordinary and necessary in one business may not be ordinary and necessary in another. So let's give you just a couple real quick examples. A computer. Okay, in today's world, name me a business where a computer is not ordinary and necessary. Okay, there might be one or two out there, and don't yell in your answers. There might be a couple out there. For the most part, ordinary and necessary. Okay. Now, how about power tools or a backhoe, right? Ordinary and necessary in a construction business, not ordinary and necessary in an accounting business. Okay. So what you need to do is understand your business well enough to know what is ordinary and necessary to your business. And then anything and everything that's ordinary and necessary, you take as a deduction, okay, as an expense in the business. Okay. So let's look at a few things here that are pretty common across businesses that we get a lot of questions about. One is vehicle expenses. Okay. Many small businesses don't have a 100% business use vehicle, right? A lot of small businesses, you've got your personal vehicle that you're also using to run your business in. Now, you can still take vehicle expenses for the business portion, the business use of your personal vehicle. Okay. The very first thing that you need to do, though, is you need to keep a mileage log. Okay. And of course, as everything else, it's just easier to keep a mileage log as you're going. Going back and recreating them can be very difficult. And here are some things that you need to have in your mileage log. And this is for the personal mileage. Okay. Or I'm sorry, the business mileage. That's the log that you need to keep track for is are all of your business trips. And what you need is a beginning of the year odometer and an ending of the year odometer number. That gives you the total number of miles driven for that vehicle in a year. We do need that number. Now, for every business trip, you need the beginning and ending odometer, okay, or mileage in the vehicle for that trip. That will give you the number of miles for the trip, right? You need the date of each business trip. Like I said, beginning and ending mileage for each trip. You need the starting point, where you left from and where you went, okay? And you need to show in there the purpose of the trip. Okay, those are the basics for a mileage log. And it's important to keep a mileage log. If you don't have one, the IRS can just say, if you were ever looked at, right? The IRS could just say, prove that you use your vehicle in business. They know that you use it, right? Now it's how much. This proves how much, okay? And they can't really question this. Well, they could question it, I guess, but they're not going to win if you've got a really good mileage log, okay? Now, there are two methods for deducting vehicle expenses. There's the actual cost method, okay? And with this method, using your mileage log, you establish a percentage of use for that vehicle, okay? And it's going to, I know that percentage of use is going to change year to year. That's okay. But you're going to establish through the mileage log the percentage of use. So if you drive for business 15,000 miles and you drove the vehicle 25,000 total, that's 60%. Okay. And that establishes your business use. Then what you can do is you can take that business percentage use, 60% in this case, for my example, and you can take 60% of the cost of the vehicle and depreciate it over time. Okay. You would also get 60% of your fuel expenses for that year, 60% of your repairs and maintenance for that year, 60% of your insurance for that year. Okay. That is one method of taking the vehicle expenses. The other method is often called the mileage method or a simplified method. And using your business log, your mileage log, you can just take a flat rate per mile. In 2021, the flat rate is 56 cents a mile. Okay. So in that example that I had, 15,000 business miles at 56 cents. Do the math really quick in my head. That's $8,400 deduction that year for auto. Okay. Now, what you want to do is you want to say, okay, which method is going to be the best over time? Because as you'll see on my next slide, once you choose a method for a vehicle, you have to stick to that method for as long as you own that vehicle, for the life of that vehicle. Now, if you get a new one or a different vehicle, you can choose a different method for that one. But once you choose a method on a vehicle, you have to maintain that same method. Now, what we look at is we say, okay, what is going to be the best deduction over the life of that vehicle that you're going to be using in business? It comes down to really how much does the vehicle cost? How much does it cost to run and maintain? and how many miles are you going to drive. Okay. Now, if you have a low cost vehicle and you drive a ton of business miles, the mileage method is more often than not going to be the better method. It's going to give you a larger deduction over time than the actual costs of running and maintaining the vehicle. Okay. And so we want to look at that, but you can choose either method. Now, if you've got a really expensive vehicle and it costs a lot to maintain, but you have to have it for your type of business, you take the actual costs. At a minimum, you're going to be able to actually deduct what your actual costs are. Okay. Under the mileage method or the simplified method, you can actually deduct more than the cost. Okay. So something to keep in mind when it comes to vehicles. Two methods. Okay. And we already spoke about this. Once you choose a method for the vehicle, you have to maintain that same method for that vehicle as long as you've got it, okay, for its life. If you go cost in year one, you got to go cost until you get rid of that vehicle. Or if you go mileage in year one of having the vehicle in the business, mileage until that vehicle is gone, okay, until you get another one. All right. How are we doing on time? We're doing great on time. And another deduction that is often brought up is the home office deduction. Okay. So business owners that use an area in their home exclusively, with a couple of exceptions, but the terms are exclusive use. Okay. For business, you can take a deduction for some of your general housing expenses. And so what would count in most cases, like a spare room where you've got your office set up, and that's where you do all of the majority of your business. Okay. You're there. That's the only thing you use that room for. What doesn't work, the couch in your living room, the dining room table generally is not going to work because you do other things in those areas, right? So it needs to be exclusive to business use. Okay. Then what we do is we get a percentage based on the square footage of the office area and the full home. Okay, if the room that you're using is, I'm going to use easy math here, 200 square feet, it's a big bedroom, I don't know. And you've got a 2,000 square foot home, well, that's 10%. Okay. Now there's really no maximum, and actually I'm going to take a step back because there is a simplified method here, which I did not put in my slides. There is a simplified method. And so let me get to that here in a minute. So yeah, you establish a percentage business use of your home, just like we did with the vehicle, using the mileage log. In this one, we're going to use square footage. Okay, the square footage of the office divided by the square footage of the total home. In my example, I'm going to use 10%. And 200 square feet, because there's two methods. There's an actual simplified method, which is just $5 a square foot up to 300 square feet for the entire year. So your maximum deduction there tops out at $1,500. In my example, 200 square feet, $5, maximum office deduction for the entire year would be $1,000. Well, some of you I know live in much larger homes, or in areas where if you're renting, the rent is very expensive. Okay. So the simplified method doesn't work for a lot of people really well. It takes a lot less documentation, right? Because you say, I measure the square footage of my home. Doesn't matter about percentage. Doesn't matter about any other costs. It's just $5 a square foot for the year for my office use or office space. Okay. Now, using the cost method, or the one that I've got here in PowerPoint, you would be able to take, in my example, 10% of some of your general housing expenses. For instance, your mortgage interest, not your mortgage payment. Okay. Oftentimes people will say, hey, give me your mortgage interest, or I'll have it on a 1098 interest form anyway, but they'll tell me how much they paid on their mortgage. Not the right number. Okay. Because the mortgage payment includes your principal. We don't want that. Because that can actually be, there's another way of taking that portion of the deduction. So it's your mortgage interest, property taxes, cost of your home. This is where the principal kind of a part of the loan may come into play. You don't take the principal part of the loan, but you are able to take, let's say, 10% of your home and depreciate that cost over a certain period of time. Get a small deduction there. Insurance, okay? And those are things if you own the home. If you rent, the amount that you pay in rent, 10% of your rent. If you're in New York or San Diego or San Francisco or, my goodness, Denver, Chicago, these other places that have really, really high rents and you're renting, I mean, you could be paying $3,500 a month in rent. I'm going to make the math easier, $4,000 a month rent, 10%, $400 a month. That's $4,800 a year in just the rent. Way better than the simplified method, right? So it depends on where you are and what your costs are as to which method we would use. But you'd also get 10% of like your utilities, water, sewer, gas, electric, okay? And general repairs. Now, if you're renting, this isn't a big deal, but if you own your home and you put a new roof on, well, the roof covers your office space as well as the rest of the home. So you get 10% of that cost as a business deduction, okay? Excuse me, I'm take a little drink here. All right. Another point of planning or another deduction that you can take as a business owner is depreciation. Now, depreciation is expensing a long-lived asset, something that lasts more than a year, okay, and you expense it over, you spread it out over its useful life. Now, the useful life is set based on the asset, okay? These are set in code. The Internal Revenue Code determines what the useful life of something is, okay? For most vehicles, their useful life is 5 years. Now, you may drive a car for 15, but the useful life for depreciation purposes is 5 years. Most equipment is 7, okay? Computers are 3, computer software is 2. They've got a whole bunch of, you depreciate cows, and if you're a milk farm or a dairy farm, there's everything that has a longer than 1 year life has a depreciation schedule attached to it. So let's say you buy an asset. I'm going to make the math easy again, a $70,000 piece of equipment. You're a contractor, I don't know, something. Well, over what we call a straight line method, that would be $10,000 a year, each year for 7 years. That's very simplistic, okay? But you get to deduct it. And you don't have to pay cash for that $70,000. Or that $70,000 piece of equipment. You could have actually financed it, okay, and still you get it deducted, even though you're not out $70,000 out the door. Now, with depreciation, remember I told you there's this, in the case I'm using a 7-year life for this piece of equipment, right? We have what's called bonus depreciation and Section 179 depreciation. And this gives us the option to take a larger part of the cost of either the vehicle or equipment in the year that it was placed into service. So if we're talking about an asset, $70,000 over 7 years, that's $10,000 a year. Well, if you had high income in 1 year and you needed a piece of equipment, right? Now, we're not going to go out and just buy equipment to have a deduction. That doesn't make sense. But you need the piece of equipment in your business, and you go and I don't care if you pay cash $70,000 for it or you finance it for $70,000. Maybe you put down $7,000 or $10,000 on it so you can get financing. And then you finance it over, I don't know, 5 years, 3 years, 10 years, whatever it might be. We can take that $70,000 and in the first year, take all 70,000 as an expense. So let's say you're in a situation where you have really good income in 2021. That's the year that we're in. Okay, we're still preparing 2020 tax returns, so I get confused. We're in 2021. You have huge income this year. For some reason, it bumped up really, really big. But you know that in future years, it's going to drop down a little bit, or at least remaining the same, not going to go way up. You would be able to buy that $70,000 piece of equipment and take a $70,000 deduction this year, potentially. Okay, there's some rules in there, but depreciation does give us an option to pull future expenses into a current year and take the deduction now. Okay, within reason, within rules, but there's some things that we can do with depreciation. Okay, awesome. Let's see, what else do I have in here? Self-employed health insurance deduction. Okay, now this is for individuals that don't already deduct their health insurance premiums through like a payroll or an employer, okay, somebody else, okay, because those are already taken out pre-tax, okay, they're already in essence been deducted. But if you're a self-employed individual, and this includes owners of S corporations, now there's a caveat to the S corporation, which we won't go into today, but it can still be done with S corporations. Self-employed individuals can take a deduction for health insurance premiums that have not already been deducted through like payroll through another employer. It's called the self-employed health insurance deduction. And the nice thing about this is you can take healthcare deductions already, sort of, through an itemized deduction, but with the increased standard deduction, most people don't itemize, and there's limitations that would strip away a ton of your healthcare deductions, even if you had enough to itemize. The self-employed health insurance deduction is a 100% what we call above the line deduction, which means there's no limitations to it except for, well, the amount of your income. If you don't have enough income, the deduction brings you down to zero, but not past that. Okay. So it can be a great deduction if you're not already having your healthcare, not healthcare in a total, but health insurance deductions or deducted. Okay. It can be done as a self-employed individual if you're not already doing it through, say, an employer. Okay. Let's see, I think that might be all that I had in my presentation ready to go as far as the PowerPoint. There are a couple of other things that I didn't put in my PowerPoint. One could be their choice of entity, but a little bit more of a complicated issue. We could do a whole entire deep dive webinar on the potential benefits of an S corporation. Okay, that's one of the bigger ones that we do as far as entity type that might be able to save you a little bit of taxes. Enjoy the rest of your day. Thank you for participating today. We enjoy these types of things here at Mazuma, enjoy answering your questions or working with small businesses. Let us know if you have any other questions. That's great. Otherwise, we'll go ahead and sign off. And again, have a great day. Thank you for attending.